Options are used to manage the risk-return trade-off from a particular exposure or position. They are a form of insurance where a premium is paid upfront and the option is only exercised if an unfavorable event occurs. Options provide the right but not the obligation to buy or sell the underlying asset or financial instrument at a fixed rate on or before a fixed future date. A bought currency call or put option can be utilized depending on the situation. A bought currency call option or CAP provides the right to buy that currency and sell the foreign currency at the strike rate. This is useful for an exporter to hedge against unfavorable or upward movements in the domestic currency. Assume the current Australian dollar to US dollar spot rate is 0.75. We can see how $2 million reduces in its dollar value as the Australian dollar appreciates above 0.75. As an example, at the spot rate of 0.75, the Australian dollar equivalent is 2,666,667. At the spot rate of 0.8, the Australian dollar equivalent is 2.5 million. To hedge the expected receipt of $2 million, the exporter could purchase an Australian dollar call option, providing it with the right to buy Australian dollars and sell US dollars at the strike rate of 0.75. Note that an Australian dollar call option is the same as a US dollar put option, being the right to sell US dollars at the strike rate of 0.75. Such options are therefore often referred to as Australian dollar call or US dollar put options. As can be noted from the table, the minimum expected receipt is therefore hedged at $2,666,667. At maturity, if the spot rate is above the strike rate, say 0.8, then the exporter will exercise the option and buy Australian dollars at the lower rate of 0.75. However, if the spot rate is below the strike rate, say 0.7, then the exporter will let the option lapse and simply buy the Australian dollar at the lower spot rate of 0.7. A bought currency put option or floor, on the other hand, provides the right to sell the currency and buy the foreign currency at the strike rate. This is useful for an importer to hedge against unfavorable or downward movements in the domestic currency. Assume the current Australian dollar to New Zealand dollar spot rate is 1.05. We can see how $1 million New Zealand dollars increases in its Australian dollar value as the Australian dollar depreciates below 1.05. To hedge the expected payment of $1 million New Zealand dollars, the importer could purchase an Australian dollar put option, providing it with the right to sell Australian dollars and buy New Zealand dollars at the strike rate of 1.05. Here, the Australian dollar put option is the same as a New Zealand dollar call option, being the right to buy New Zealand dollars at the strike rate of 1.05. Such options are therefore often referred to as Australian dollar put or New Zealand dollar call options. At maturity, if the spot rate is below the strike rate, say 1, then the importer will exercise the option and sell the Australian dollar at the higher rate of 1.05. However, if the spot rate is above the strike rate, say 1.1, then the importer will let the option lapse and simply sell the Australian dollar at the higher spot rate of 1.1. The effective exchange rate on a transaction includes the impact of the premium. When we buy a call option, we add the premium to the strike rate to determine the effective rate. That is, we effectively pay a little more than the strike rate when we buy the underlying instrument. When we buy a put option, we subtract the premium from the strike rate to determine the effective rate. That is, we effectively receive a little less than the strike rate when we sell the underlying instrument. To recap, options provide flexibility in the management of foreign exchange exposures as they allow the purchaser to benefit from favorable movements whilst protecting against unfavorable movements. For this flexibility, the option buyer pays the option seller an upfront premium which reflects the price of that option.